Welcome to Bazaar Ki Baat. We hope that just like the markets, you had a brilliant end to 2023 and 2024 brings a lot of joy and happiness into your life. In today's episode, besides our usual market update, we will be diving deep into two of the topics. The first topic with Kshitij is about the active versus passive investing debate and how you as an investor can think about them. The second topic with Vikas is about Section 54F of the Income Tax Act. This is extremely useful for people who are investing in equity either through stocks or mutual funds and are looking to buy a property. But before we begin, the usual disclaimer, anything that we share here is purely from the perspective of spreading financial education, and none of this amounts to any financial advice. So, welcome, Kshitij. I know we have been talking about this for a few months now, but clearly the Indian equity markets had a great month. Nifty 50 saw close to 8%, similar kind of returns for mid and small cap. What do you think has been fueling this rally?
Yeah, so to my mind, there are several reasons for this outperformance by Indian markets because this is not a global phenomenon. Indian markets have shown brightly across the world. Just to list down the points, I think one of the important reason or one of the most cited reasons is that we've been the fastest growing large economy. The other economies are slowing down globally. So India has been that shining star in that sense. Secondly, our corporate earnings have been robust. India's net profit as a percentage of gross GDP is almost reaching 5% now from the lows of 2% somewhere in 2021. So there has been a very sharp upswing since then. Domestic fund inflows, which has been the story of this last few years, mutual funds retail through their mutual fund investments in equity schemes have come in large numbers. Just to put in perspective, we have seen 1.7 trillion investment equity purchase in 2023 and MFSIP, which we have been tracking quite closely. In December itself, they touched 17,000 crore every month. So if that kind of number is keeping markets afloat. And then I think overall, this some part of credit has to go to the government also. It has been a decade of big reforms in India. Reforms like GST, corporate tax cuts, IDC code, UPI, PLI schemes, all of which are now culminating into growth and strong corporate earnings, right? So it has not been a debt fueled economy. We have been very conscious of our fiscal deficit also. So in that sense, India has shown how sustainable growth can be. And lastly, because of all these reasons, we saw that FPI flows are coming back in somewhere late of 2023. We saw FPI coming back to India in hordes, right? And also this has been a story of change over the last decade or so. In 2013, India was only 6.4% of the MSCI emerging index. Now that has risen to 16.3%. And some part of it is due to the underperformance of China, but a large part of it has to go to India. So the net FPI flows for India has been close to $17 billion in 2023, while the rest of the emerging markets have seen nominal flows. So India has been an outperformer in almost all the categories, and that has been the reason why equity markets have also done well.
And when we look at all of these sectors, the rally, largely looks broad based as well. Most of the sectors have done well. So, do you think there are certain tailwinds to some of these sectors that is, helping them really outperform the broader market?
Right. I think if you look at the themes which have worked, are normally those are the themes which or the sectors that not work traditionally in India, right? The reality or the defense or the power sector, or for example, heavy industrials, which are capex oriented sectors, because the government is actually trying to do large amount of capex with the hope of crowding in investment, private investment or private capex. So those are the things which has worked in 2023, and those are still relatively cheaper and may continue to do well. Apart from this, themes like luxury consumption, the EV, renewable, electronic manufacturing, which have been driven by government schemes like PLI. they have also done well in 2023. And these are normally companies in mid and small cap, right? So that is the reason of this large outperformance by the mid and small cap over the large cap peers. The large cap is largely contributed by banks, IT, and FMCG companies. And those companies have not done well, right? However, if we look going forward, these are the sectors which are favored by FPIs. So if the FPI flows comes in 24, these sectors may outperform or maybe the leaders of the next round.
Right. So clearly, I mean, 2023 has been so much of a bull rally, right? So, in your view, should one exercise caution or we can continue to be optimistic about growth in 2024?
I think if you are a near-term trader, so post the recent rally, I feel that the market may go into a consolidation phase for the next few months, right? Especially in the run-up to the election. Though data says that in the run-up to the elections is normally has a positive tilt to the market, but most of the time that data has been on when the valuations were low. If you also put in a valuation perspective to that, then I think that data falls flat, right? 2024 is not just an election year in India. We are seeing approximately 70 countries, including India, which are slated to hold a general election. So globally, we will see volatility. But having said that, nobody really knows, right? So we can regarding predictions. I think we should humbly accept that we don't know what markets will do. Almost all the big global asset managers, banks, and everyone predicted a very sharp global slowdown at the start of 2023, which didn't pan out. US did well. So a lot of things didn't work out as was the outlook. So nobody really knows. However, one thing which we can relatively certain, if you look for the medium to long term, is that India is going to do well and that it will continue to benefit from the robust macro indicators, strong corporate earnings, sustained MFSIP flows, and the resumption of FPI flows. So all these factors will continue to push India forward. And in addition to that, now that the Fed rate, there is expectation of Fed rate cuts in the second half of calendar year 24, that may provide another set of tailwinds to the EM markets. So
Hmm.
my sense is post this recent rally, just focus on asset allocation. Make sure the recent rally has not taken your asset allocation very far from your target allocation and just readjust that. In my view, you cannot wait for market corrections to happen. That is a suboptimal strategy. And I think long back Peter Lynch said that far more money has been lost by investors preparing for corrections or trying to anticipate correction than has been lost in corrections themselves. So basically, being invested is the key. Markets have a positive bias. Just make sure you are invested.
And just for our viewers, if you want to hear our views on how markets behave in the years of elections, do visit our YouTube channel and look at our December video. We spoke about elections there. So let's move to our first topic, Kshitij. There is a lot of discussion about active investing versus passive investing. So just for the benefit of our viewers, can you tell us what exactly is passive investing?
Right. So see, passive investing is very simple. It is a phenomena where you are avoiding to take active decisions. Basically, you're trying to buy something and just follow that index, right? You just follow a principle and not deviate from that. Do not take active calls over it. You just follow the algorithm. The algorithm can be as simple as highest market cap, like a Nifty 50, or it can be highest earnings. In effect, Nifty 50 is like a momentum index. So whatever is doing well will have higher allocation, whatever is not doing well, and if it does very bad, it move out of the index and you will exit. So you don't have to worry. So passive indexing is basically trying to shift your decision point to algorithm. So you're not taking those decisions.
Okay. So obviously passive investing is in contrast to active investing, and we see that there's, like the claim of the active fund managers is that they consistently outperform benchmarks, but we can clearly see that data is very debatable on this front. So what do you think, are active fund managers being able to outperform their benchmarks? Of course, we look at India in a bit, but what is happening globally?
Right. So just to just to from a perspective point of view, the market share of passively managed funds in US is now reached over 50%. So the passive is definitely winning the battle over active, and this is a global phenomenon. And even in India, we have reached to up to I think 17 to 18% of the market share has been grabbed by passive, right? And just to look at the how the performance has been for active managers, S&P comes out with their SPY performance, which is I think short form of S&P indices versus active, which has become a benchmark for how active managers have been performing across geographies versus their respective benchmarks. And the results are impressive and consistent across the world. Indices tend to outperform majority of actively managed funds, right? Mainly over the medium to long term investment horizon. So, like for a year, it may happen that a large part of majority active managers did well in a certain geography, but if you look at a 5 year, 10 year period, almost all the countries give the same indication that the active managers are not being able to outperform their benchmarks, right? The chart here, which I have put, is showcases percentage of large cap active funds underperforming their assigned benchmark over 1 year, 3 year, 5 year. So if you see at 5 years, almost all of them have an increasing trend, 1, 3, 5, right? So as the
Right.
time period increases, not only their underperformance increases, but if you look at the survivorship of these funds, right? A lot of these countries will see that the because the underperformance comes in as the time period increases, the survivorship also drops. If let's just talk about the larger economy, US, so close to 87% of the large cap funds underperform in a 5 year period. And this
Right.
percentage keeps on increasing as we go from 10 year, 15 year, 20 year period. Almost all of the types of equity funds, so not just large cap, almost all types of equity funds have more than 80% of their managers underperforming over a 10 year period. And such performance can be harsh to managers, like I said, and over a 10 year period, only 66% of the funds are there, right? So almost 33% of the funds are actually closing down within a 10 year period. In India, which is a relatively smaller market, we have 30% of the large cap active funds underperform their S&P BSE 100 over a 5 year period. And we'll talk about this later, maybe in the next slide. And if you ask me which of the countries have done well, for some countries like South Africa, MENA region, I think the performance looks better. But if we look closely, I think this is only one against one benchmark. Overall, if we look at the whole holistic picture, the active managers are still doing bad there also. So nothing
Hmm.
changes per se.
Yeah. I think numbers for India also, look very alarming for that matter, given that passive has only captured around 17% market share, you say. So in India, I understand this is the large cap universe that we are looking here, but are all the active fund managers underperforming? And if they are, if such a high number of fund managers are underperforming, what's the reason that, passive has grown in share and active is finding it so difficult to outperform?
So in India, I think the story is largely large cap oriented in the sense the large cap funds have struggled over the last few years. Among all the categories, if you look at the SPY India scorecard, I think the equity, mid, and small cap funds have fared the best, where only 38% of the funds are underperforming S&P BSE 400 mid and small cap index. And I think I've written about this on LinkedIn also. There are three simple reasons of the underperformance of large cap active funds. One is obviously there is difficulty to generate alpha because the top heavy nature of the large cap index, right? Because the larger companies are the few large companies like the Reliance or like an SDFC, they are so large that if a fund manager maintains the same allocation to them, then there is not much scope to be active and generate alpha. And the only way be active is to have a different allocation in those stocks. And because this is such a such large allocation, if that call goes wrong, it can be a big job risk to the fund manager. So the issue is job risk in that sense. Secondly, I think that the regulatory changes which came in 2018 also has defined the large cap universe for fund managers very strictly, right? So only the top 100 companies, limiting the headroom for active managers. Before that, if you see, a lot of fund managers had a relatively higher share of small and mid cap in there, even in the large cap mutual funds. Thirdly, and the most obvious and the most, I think, if in attribution, if you have to attribute the largest reason is that the high cost of active funds. So simply put, I think it may make sense for a large cap and mutual fund investors to choose index funds over active large cap funds. Having said that, I think like we said, there is still value in selecting active small and mid cap fund managers because they've been outperforming. A large portion of them have been outperforming their benchmark. Also, just as a side note, I think I read some research is that even in large cap funds, the really large ones are underperforming even higher. So it's best to avoid large active funds in the large cap space. So that's the
Right.
idea.
Right. I mean, clearly, even, amongst people that we speak to, we see that a lot of them, and we also recommend a lot of our clients to move to index investing in the large cap space. But given that a country like India is a growing economy, of course, we do see, alpha in the mid and small cap space. And I think that is where most of the investors now are migrating to active investing, but moving to index investing for the large cap space. I think that's useful for investors to make decisions. Even now, a lot of investors have a lot of their money parked in blue chip funds, but it is a worthwhile analysis to go back and check whether your blue chip funds are actually outperforming the index, or is it worthwhile for you to move to index investing now. So thank you, Kshitij. I think it was very, very useful. Let us now move to our second deep dive topic for the day. So, welcome, Vikas. And Vikas, last week we were chatting and you were telling me about this cousin of yours who saved close to 10 lakh rupees because of this particular section called Section 54F in the Income Tax Act. So, before we go deeper into how can we leverage this, can you just tell our viewers what is the Section 54F?
Hi, Shruti. Happy New Year and wishing New Year greetings to all our listeners as well. So, Section 54F, what I have felt is that it is slightly not used or not very common amongst investors. Like you said last week, my brother was buying a house and he was not aware that he could save some taxes. So, Section 54F is a peculiar section because it helps transactions in capital market to be used to save tax when you're buying a residential house. So it clearly says that if you are selling your equity assets, which can be mutual funds, shares, and even unlisted shares, or you're even selling a physical gold, the gains that you derive out of it can be used to buy a house. So what is the biggest confusion over here is that a lot of people hear that startup founders and people are selling their equity stake. They feel that it is only like limited to unlisted equities where they're liquidating their stakes and all. But this is actually applicable to all of us. So anyone who is even investing in mutual funds, and if he has long-term capital gains, he can use this section to buy a house and save on taxes. So some of the nuances of this section is that you have to like have long-term capital gains. So if you are having capital gains under the head of short-term capital gains, then you are not eligible to take tax benefit under this section. Another thing is that you should have one house under your name at the time of purchase. Another thing is that you have to buy the house within 2 years of such a transaction, or if you're doing a construction, if you're constructing a house, then you get further 1 year. So you can do it within 3 years.
Hmm.
And
And
yeah.
yeah. And I think, like you rightly said, it's a little unique in the sense that most people that I speak to, they know that, if they are disposing of a property, the capital gains that they get out of that property can be reinvested into another property and, the capital gains are not taxed.
Yeah.
But very few of us know. And I think I would suspect that in most cases, even chartered accountants are not able to give this kind of guidance to people that this is one area that people can actually save taxes. So can you demonstrate this with an example in terms of how can somebody really use this section?
Yeah. And also, I like to say, see, in my case, why it was more perplexing is that, see, a lot of times what happens is that you may have your own funds also. So maybe you are buying this house from a loan, or maybe you are buying it from your own sources. But if you have some accrued long-term capital gains, you can just book it and you can buy those things again. So it's a tax planning exercise also. So in this case, what was happening is that the investor had money to pay for the house, but that can be used to reinvest in the equity assets, and those equity proceeds can be used to pay off that housing liability. So this is also a reason why a lot of people miss out on this booking of your equity gains to buy a house. So just
Right.
to give you some example, so what happens is that if you have, say, suppose you have bought equity shares worth 20 lakh rupees, the present value of which is say 1 crore. Mutual funds, you have another investments which is invested value is 30 lakhs and current value is 65 lakhs. So if you do if you have this kind of investments, and if say suppose you are planning to buy a house, but what happens is that the gains on these kind of investments, if you calculate, would be close to 1.15 crores. So your gains is 1.15 crore. On that, since it's long-term capital gains, you are liable to pay 11.5 lakhs. And this 11.5 lakhs is your tax liability. Actually, you have to pay. But if you use these proceeds to buy a house, what happens is that this 11.5 is non-taxable to you. So this is a significant savings where you can plan this if you're buying a house. All your accrued long-term capital gains can be used to buy a house if you have a residential house need. There are a couple of things that you have to be very careful about is that this is not applicable. Say suppose there's some confusion that my I have to only invest my gains. So that is not applicable. So in this case, if you are investing, say only 55 lakh is your principal, and if you are only investing 1.15 crores, then you'll not get the entire tax deduction. You have to invest the principal plus gains, everything, then you get this tax deduction.
Correct.
Another, just wanted to add one more thing. So what happened is that I had one inquiry from a startup founder. He had sold his company and he wanted to invest this house in a property in Lonavala. So over there, the income tax is very, very clear that you cannot buy it a commercial house or a farmhouse kind of thing, which is used for like commercial purposes. So you're renting it out to visitors. So that is not permissible. It is only for your residential house that you get this deduction.
Right. But I think your brother ended up making a lot of savings. And I think it's useful to know because, the people we speak to, Vikas, a lot of them are, having a goal to buy their own primary residence in, next 10, 15 years. And at the same time, we know that India is a growing economy. Equity can create a lot of wealth. But a lot of times people don't plan for how to accumulate the corpus that will be required to buy the house. And by knowing this, they know that there could be a very, very good kind of tax planning that can be done with their equity holdings. And when the time for the house purchase comes, they can actually make use of this corpus. So I think that's a very insightful part to know about tax planning. And we hope that the episode is useful for our viewers. Stay tuned for our next season. And once again, a very happy new year to everyone.